Hello, everyone, and welcome to the podcast for this week. In this week's podcast and lecture, we're going to explore the concepts of money and investment, as well as the international regulatory system that has developed to monitor and control those two things. Now, you'll notice that I cover some different material in the lecture book this week as compared to the text. I added in some basic topics to make sure that everyone has the necessary background information. In the topics this week, we're going to look at the process of investing in foreign markets, the information that needs to be provided, the approval process associated with those investments, and also how to structure your business so as to minimize legal risk and exposure. We explore the trading of securities, both domestically and internationally, as well as national and international banking systems. You see, for public companies, the sale of securities offers a relatively quick way to raise significant amounts of capital. But participation in the securities markets is not without risk, both from a market perspective as well as from a legal perspective, and that's particularly true when securities are being bought and sold internationally. It's because of the mobility of capital that complex international and national regulatory systems have developed over time. We begin with the topic of foreign investment, which has a number of benefits. Indeed, all states want to encourage foreign investment in some ways, though in a lot of cases there's a palpable tension between domestic and foreign ownership interests. You see, domestic interests will want to protect their, quote-unquote, their territory, even if allowing foreign money may be beneficial to the economy at large. So, what is foreign investment, also known as foreign direct investment or FDI? First, it is distinct from simply buying and selling a few shares in a foreign entity. See, not every investment by an individual in a foreign country, company, or market classifies from a legal perspective as a foreign investment. Generally, it has to be of a certain magnitude. In order to qualify, the general standard is that a foreign investment must involve one person or commercial entity owning at least 10% or more of a controlling interest in a foreign enterprise. But that is not a legally binding standard. Indeed, most most national laws set their own standard. There's no international treaty that lays out the specific terms. So if you're thinking of investing, you need to examine a country's specific laws to ensure that you are complying with state policy. And in some cases, you may want to go over that kind of threshold, and in some cases, you may want to stay under the threshold so you don't have to comply with the regulatory requirements of investing. Now, foreign investments are usually regulated by something called bilateral investment treaties, or BITs. These are usually between the country where the investor is and the country that is being invested in, and they set up a variety of rules regarding compensation, expropriation, performance, dispute settlement, who gets to sit on the boards. And indeed, they're not always negotiated between developed and developing countries. Sometimes they're negotiated between major economies. China and the United States are in the midst of negotiating such an agreement now that is likely to be of historic significance. Now, BITs also lay out the process that an investor must go through in order to get an investment approved. There are a number of forms that you have to fill out, and I thought I might take you through an example looking at an investment application form for the Maldives, a small island nation in the Indian Ocean. Now, as you can see, the process requires you to identify the type of investment, what the structure of the organization will be, what the organization will do, how much the investment will be, where the funds are coming from, how long it will last. And it also asks certain information about the investor, who owns the company, their trusts, provide the corporate profile of the investors, the business profile of the investors. And additionally, then there's a number of declarations you have to make about your appropriateness for investment. Often they deal with whether you've been convicted of felonies. Again, you have criminal charges here that have to be declared if they exist. And then finally, you have contact details for the investment, privacy notices and the like, and then you fill it out and sign the form. That's a very simple kind of investment application. Note that you do have to submit a lot of documents such as letters of credibility and good standing, and here's the administration fee. So you're required to pay a $2,000 administration fee just to do the investment. So that's an example from the Maldives. Now, if your investment is approved by the authorities, work begins, but the project is subject to constant oversight to make sure that the goals laid out in the original application are being met. Now, when making a foreign investment, as you saw, one of the things you have to identify, and in fact one of the most important considerations to make, is how to structure your corporation. You see, there are a number of options that have a range of responsibilities and potential liabilities. When choosing a business form, you do have to be aware of the various regulations you'll be subject to, as well as the protections and risks associated with each type of entity. Now, companies can choose to establish partnerships, distributorships, representative offices, or local subsidiaries, and all have different benefits and risks, and we discuss some of these in the chapters and the readings this week. Now, with respect to which regulations will control your business, you have to take into account two sets of laws, both the laws of your home state, where the business is based, and the laws of the host state, in which you will conduct your business. This is a critical point to understand. In operating in a state other than your state of incorporation, a business must follow the laws of that host state as well as the laws of its home state. That means for a multinational enterprise that operates in many different countries around the world, having to comply with multiple legal and regulatory regimes is a cost that simply must be priced into any discussion of future expansion and development. Indeed, in a global marketplace, the profit potential of a multinational enterprise is staggering, and many businesses look for opportunities to expand internationally. However, operating as a foreign registered company in a foreign country has many legal pitfalls and challenges that all lawyers and businessmen must be aware of and should take into consideration prior to entering into the business in the foreign location. We'll talk about those in the readings and the lectures this week. Very briefly, first, doing business in a foreign country may not be cheap. It can be very costly. A company must be knowledgeable about its filing requirements. Most countries require that all companies, including foreign companies, file at least an annual statement with the government, and some require many more filings, perhaps as often as quarterly. Filings can vary widely in what information is required, depending on the type of business. But the more that is required, the more costly it will be to prepare. As a result, an international business person has to think about the resources its employees will have to devote to the filing, whether it will need outside support from law firms or accounting firms. All that costs money and should be taken into account when assessing the business viability of establishing international operations. Now, second, when looking to establish foreign operations, a multinational enterprise must familiarize itself with local regulations governing its operations. It needs to understand the regulatory environment of the host state with respect to environmental rules, labor and employment, taxes. All those should go into your decision as to whether to open in a particular country. Many states, for example, have local participation laws, which require a multinational enterprise to partner with a local company before it can open up an office. Establishing that relationship can cost money, and the resources that have to be calculated in a final cost determination must include those factors. Now, finally, an investor must think about risk. Various forms of business may expose the parent company to liability, which is something that the company may want to avoid. You have to understand the legal system that you're going to open your business in. What are the rules regarding parent subsidiary liability? Now, another risk of doing business internationally is that you have to deal with foreign currency. This is particularly true when you're dealing with currency from developing countries, which can have unstable value and lose their money value quickly. So one thing that you have to think about when doing a business abroad is to make sure the currency being used under the contract is stable and will not devalue dramatically over time. Now, there are a number of ways you can do this. One, you can include what's called a maintenance of value clause. This clause in a contract will allow for adjustments in the contractual price to match changes in the valuation of the currency being used. A second option might be to just simply use a stable currency. Choose a money of account like the US dollar or the euro or the Japanese yen, a currency that doesn't have much fluctuation in value. And finally, you can use what's called a currency basket. This is where the prices in the contract are set at based on different currencies, different stable currencies at different levels. So perhaps you have your 50% of your contract price will be determined by the value of the US dollar, maybe 25% each determined by the value of the yen and the euro. It's a little bit complicated to set up, but it does provide protection against problems with any single currency. Now, the international system has also built in various regulatory mechanisms like the World Bank and the IMF to help protect currency value, and those will be discussed in detail in the readings this week. Now, finally this week we discussed the concept of taxation. And taxes are simply a reality of existence for corporations, and in any large organized society the ability to raise money through taxation is critical. Indeed, that was one of the founding principles of our nation. The ability to levy taxes was considered a critical component of the U.S. Constitution. As founding father, fourth U.S. president, and drafter of the U.S. Constitution, James Madison concluded, "The power of taxing people and their property is essential to the very existence of government." Now, as a business person, you have a duty somewhat in trying to lawfully generate profit for your shareholders. And there are other interests that we previously discussed, but with respect to profit and taxes, you arguably have two duties. The first is to pay all the taxes that you legally owe to all the governments that you legally owe taxes to. And second, to use diligence in employing corporate strategies and techniques to minimize your tax burden to the extent legally possible. This week we'll discuss what types of strategies are permitted, including potentially corporate inversions, and which are not, as well as issues that a professional must watch for, such as the existence of tax treaties and the basis of taxation. That does it for this week's short introductory podcast. Let me know if you have any questions, and I will see you on the discussion boards.